In this video, I'm going to talk about a few remaining other business uses of life insurance. So the first one that I'm going to talk about is split dollar life insurance arrangements. So for the split dollar life insurance arrangement, um, basically what we have is a situation in which um, there's kind of an overlap between the employer and the employee, in which both are involved in some level of either the payment of premiums, or the benefits, or so forth, and that's what's leading to kind of this split dollar terminology. So there are a couple different ways that could be done. So for the endorsement method, basically what's happening in this case um, is the employer owns the life insurance policy, and the employer is paying the premiums. But if the person, the insured person dies, basically what will happen is the policy will pay out, and then basically the employer will recoup the costs of the policy and the premiums, basically. And then whatever is remaining will be paid out to the beneficiary. So it's kind of an interesting mixture there, where it's kind of the employer paying for it, but the employer is also going to take some of the benefit. But if there's benefit in addition that's left over, well, then that goes to the actual beneficiaries that were listed by the employee. So it's kind of an interesting mixture, hence the split dollar life insurance terminology. The another way this could be done would be through a collateral assignment method. And this is one in which basically the employer loans money to the employee, which then pays for the policy. That loan has to be repaid. And so at the death of the employee, the loan is repaid first, and then whatever is left over is paid to beneficiaries. So again, it's kind of a situation in which multiple entities are kind of have a claim on this, and so hence the split dollar kind of terminology associated with that. And there can be some income tax implications for some of these kinds of things. So for instance, if the employer is giving a loan to the employee to pay for this, then to the extent that that loan is essentially like charging less interest than would normally be charged, then technically this is a below market rate loan, and so you would have all of these kinds of considerations basically that could come into play with something like that. And so from that standpoint, um, it there are some tax implications associated with this. So you have to be kind of a little bit careful about what that would potentially mean. So it depends on the agreements that were reached and so forth, but there are tax implications. Also, a company may purchase key person life and disability insurance. So this would basically be an insurance policy purchased by a business. Let's say that there's a key CEO or a key executive, like a CEO or chief financial officer, or something like that. That it would be a significant issue if that person passed away. It'd be really damaging to the company. So they could purchase a key person life insurance policy that the company would receive a large payout in the event that that person passed away. And then they could use that money to help train people to fill in that role that was now lost. And you can do something similar with disability insurance. If the person becomes disabled or something of that nature, the same kind of thing. Now, typically in that case, the premiums for this are not considered to be deductible by the business. Also, as an interesting little note, there are some issues as it relates to kind of executive compensation typically, and kind of term life insurance coverage. So in prior videos, we've discussed the like the standard term life insurance policies, so group term policies and things like that. Well, in order to perhaps provide more term insurance coverage, sometimes what companies will do is they'll create what's called a Section 162. So Section 162 group carve-out plan. And basically what they'll do is they'll carve out key employees like executives typically and things like that. They'll carve them out from the main group insurance policy. And so the main group insurance policy pays like that, say that $50,000 death benefit or something less than that. And then the executives would be in sort of a separate group, and they would provide more term life insurance coverage as a means of trying to attract executives. Now, what gets interesting is the treatment for owners versus employee eligibility can be very different. So there are a variety of different compensation kind of plans and features and things like that that are not considered to be they're not owners are not generally eligible for, at least not for like tax treatment and things like that. So if you are an owner, you are not eligible for some of these kinds of plans. In the case, at least it would affect tax deductibility and everything else. And the reason for that is basically if you were an owner, you could try to create creative compensation packages and fringe benefits and things like that that the company's paying for, and then try to avoid triggering taxable events, right? Well, as a result of that, basically the government views owners and employees differently. So if you are in the owner category, there are certain types of plans and fringe benefits and things like that that basically you can't really do for, at least not and be tax deductible and all that. And if it's just a standard employee that does not have the ownership interest, that's fine. But if you got the ownership interest, then it kind of, the government views that as potentially creating a scenario in which somebody would try to sidestep some of those tax regulations. So so basically, with that in mind, let's assume we don't have ownership interests. Okay. So if we don't have ownership interest, then what for those executives, then what you could do is basically carve out executives and basically provide more term life insurance coverage for them, and possibly pay for that as part of a benefits program, and potentially that may actually wind up being deductible, particularly if the company can document things like the market cost associated with hiring the executives and things like that, and kind of argue, well, the true market cost of hiring the executives, like this is what's necessary for a compensation package to be able to get an executive. And so they may be able to retain some tax deductibility and things like that in that context. But some of that would not be possible if the people who were receiving some of those benefits were owners in certain capacities. So that's something that would be you have to be monitored that kind of carefully. Okay, hopefully this clarifies some interesting ways that businesses can use, other ways they can use life insurance. Hopefully it helps. Thank you for watching, and have a great day.